Good morning, students. I am Dr. Managavi, Assistant Professor of Economics Department. Students, in today's class, we are going to discuss about the working capital finance as well as the sources of the working capital finance. So, working capital finance, in the sense, it is business finance. It is designed to boost the working capital which is available to the business. So often we are using this capital for the growth of our projects, such as taking on a bigger contract or investing in a new market. So different businesses use this working capital finance for a variety of purposes. So the general idea is that using working capital finance frees up cash for growing the business, which will be the short to medium term. There are many different types of lending that could be considered working capital finance. Some are explicitly designed to help working capital, whatever industry we are in, while others are useful for specific sectors or requirements. The working capital is the amount of cash a business can safely spend. It is commonly defined as current assets minus current liabilities. So usually working capital is calculated based on cash assets that can quickly be converted to cash and expenses that will be due within a year. Let us concentrate on the meaning of working capital finance. So mainly it is used to fund your company's investment in short-term assets such as accounts receivable and inventory. And also it provides liquidity so that our company can fund its day-to-day transactions including payroll, overhead and other expenses. So there are many types of working capital financing. The best fit for our company will depend on its industry, business model, stage of development, and the current assets of its balance sheet. Working capital finance is business finance designed to boost the working capital available to a business. It is often used for specific growth projects such as taking on a bigger contract or investing in a new market. The different businesses use working capital finance for a variety of purposes, but the general idea is that using working capital finance frees up cash for growing the business. It will be recovered in the short to medium term. See, there are some different types of lending that could be considered working capital finance. So some are explicitly designed to help working capital, but the others for some specific sectors or requirements. Let us discuss about the sources of working capital. What are the sources of working capital? We are going to clearly discuss. So the main sources of working capital finance is loans from commercial banks. See, small scale enterprises, they can raise loans from the commercial banks with or without security. So this method of financing doesn't require any legal formality except that of creating a mortgage on the assets. See, loan can be paid in lump sum or in parts. The short-term loans can also be obtained from banks on a personal security of directors of a country. So such loans are considered as the clean advances. The bank finance is made available to small-scale enterprises at the concessional rate of interest. Therefore, it is generally a cheaper source of financing working capital requirements of enterprise. However, this method of raising funds for working capital is a time-consuming process. Then the next thing is public deposit. Often companies find it very easy as well as convenient to raise short-term funds by inviting some shareholders, employees as well as general public to deposit their savings with the money, savings with the company. So it is a simple method of raising funds from public for which the company has only to advertise and inform the public that it is authorized by the Companies Act 1956 to accept public deposits. So public deposits can be invited by offering a higher rate of interest than the interest allowed on bank deposits. However, the companies can raise funds through public deposits subject to a maximum of 25% of their tied-up capital and free reserves. The next thing is trade credit. So just as the companies sell goods on credit, they also buy raw materials, components, and other goods on credit from their suppliers. So thus, outstanding amounts payable to the supplier, that is trade creditors for credit purchases, are regarded as a source of finance. Generally, suppliers grant credit to their clients for a period of 3 to 6 months. Thus, they provide in a way short-term finance to the purchasing company. So, as a matter of fact, availability of this type of finance largely it depends upon the volume of business. More the volume of business, more will be the availability of this type of finance and vice versa. So the volume of trade credit available also depends on the reputation of the buyer company, its financial position, degree of competition in the market. So, however, availing the trade credit involves loss of cash discount, which could be earned if payments are made within 7 to 10 days from the date of purchase of goods. So, this loss of cash discount is regarded as implicit cost of trade credit. And the next one is the factoring. The factoring is a financial service designed to help firms in managing their books, debts as well as receivables in a better manner. The book debts and receivables are assigned to a bank called the factor, and the cash is realized in advance from the bank. For rendering these services, the fee or commission charged is usually a percentage of the value of the book debts receivable factor. So this is a method of raising short-term capital and known as factoring. So on the other hand, it helps the supplier companies to secure finance against their book debts and receivables, and on the other, it is very helpful in saving the effort of collecting the book debts. The advantage of factoring is that the consumers who are really in genuine difficulty do not get the opportunity of delaying payment, which they might have otherwise got from supplier company. In the present context, where this industrial sickness is spreading like an epidemic, The reason for which particularly the small-scale industrial sector being delayed payments from their supplier, there is a clear-cut rationale for introduction of factoring system. So there has been some progress also on this front. The recommendations of the study group, that is RBI 1996, to examine the feasibility of setting up of factoring organizations in the country under the chairmanship of Sri Kalyansundaram has been accepted by the Government of India. So this group is to view that factoring of these small scale industrial units could prove to be mutually beneficial to both the factors and these small scale industrial units. And factors should make every effort to orient their strategy to crystallize the potential demand from the sector. Then the next one is discounting bills of exchange. So when goods are sold on credit, bills of exchange are generally drawn for acceptance by the buyers of goods. The bills are generally drawn for a period of 3 to 6 months. In practice, the writer of the bill, instead of holding the bill till the date of maturity, prefers to discount them with commercial banks on payment of a charge known as discount. The term discounting of bills is used in case of time bills, whereas the term purchasing of bills is used in respect of demand bills. So the rate of discount to be charged by the bank is prescribed by the Reserve Bank of India from time to time. So it generally amounts to the interest for the period from the date of discounting to the date of maturity of bill. If a bill is dishonored on maturity, the bank returns the dishonored bill to the company, who then becomes liable to pay the amount to the bank. So the cost of raising finance by this method is the amount of discount charged by the bank. So this method is widely used by the companies for raising short-term finance. Then the next one is bank overdraft and cash credit. The overdraft is a facility extended by the banks to the current account holder for a short period generally. A current account holder is allowed to withdraw from his current deposit account up to a certain limit over the balance with the bank. The interest is charged only on the amount actually overdrawn. The overdraft facility is also granted against securities. Cash credit is the arrangement whereby the commercial banks allow borrowing money up to a specified limit known as cash credit limit. The cash credit facility is allowed against the security. The cash credit limit can be revised from time to time according to the value of securities. The money so drawn can be repaid as and when possible. The interest is charged on the actual amount drawn during the period rather on limit sanction. The rate of interest charged on both the overdraft and the cash credit is relatively higher than the rate of interest given on bank deposits. See, arranging overdraft as well as the cash credit with the commercial banks has become a common method adopted by companies for meeting their short-term financial or working capital requirements. Let us concentrate on advances from customers. See, one way of raising funds for short-term requirements is to demand for advance from one's own customers. The examples of advances from customers are advance paid at the time of booking a car or a telephone connection or a flat. So this has become an increasingly popular source of short-term finance among the small business enterprises, mainly due to two reasons. The first reason is the enterprises do not pay any interest on advances from their companies or from their customers. Second, if any company pays interest on advances, that too at a nominal rate. Therefore, advances from customers become one of the cheapest sources of raising funds for meeting working capital requirements of companies. Right? Then if you see the next one, that is accrual account. See, generally, there is a certain amount of time gap between income. This income is earned and is actually received or expenditure becomes due and is actually paid. Salaries, wages, and taxes, for example, become due at the end of the month, but are usually paid in the first week of the next month. So these outstanding salaries and wages as expenses for a week help the enterprise in meeting their working capital requirements. So this source of raising funds doesn't involve any cost. So these are the important aspects we have discussed in today's class. Thank you, students. The remaining aspects we will discuss in the next class.